What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. In this week's episode of What's Next for Markets, I've decided to include a few clips from an hour-long discussion with Adam Taggart of Thoughtful Money. To listen to the entire discussion and see a handful of supporting charts, visit Thoughtful Money's YouTube page at youtube.com/@Adam.Taggart, that's spelled TAGGART/videos. Here's a clip from the discussion regarding my views on why this backdrop represents a post-inflation shock Goldilocks environment and why I see a slow and sustained healing in the breadth of macro and micro data. I can tell you from reading some of the comments posted in response to the original video, most disagree with these views. While I'd say Adam's followers seem to have somewhat of a negative bias to begin with, I'd also say that many of my current views are widely out of consensus. Listen in and decide for yourself.
We shut down the world. We had all this crazy stuff going on. Everybody thought we were going to have a recession in 2022, but we didn't. We've had 3 amazing years since. And then it sounds like you're saying, and the party looks like it's going to continue. Looks like maybe the economy is actually starting to strengthen here. Maybe not barn burner strengthen, but positive direction. And things look really good for equities in terms of this Goldilocks setup.
Yeah, and to me, it's more about we're finally seeing the seeds of a sustained broadening in both the macro and micro backdrop. So it's really, think of like a quadrant or a matrix, and you have got on one axis, you've got strength or magnitude, and on the other axis, you've got breadth. So if you think about for a good part of the last 3 years, we had a very strong market, but we had fairly weak breadth. So I would say what I see looking ahead is acknowledging we had a very strong market and valuations are high, credit spreads are low, and there's not a lot of risk priced into markets today. What I see is not necessarily a market that's going to continue to boom, because for that to happen, I think you need to continue seeing a multiple expansion. And I think we're kind of long in the tooth of that story. But I do see the conditions for earnings to start broadening out. So I think you'll see a market that is not as strongly led by the top 10 largest stocks or just large cap growth, which we have seen some of that in recent months. What I believe is that we're finally getting to a point where it can be sustained. This is the 6th rally where small caps have outperformed large caps since 2023. And on average, they only lasted 30 days. And the reason, in my opinion, why they didn't sustain, because the whole rally took place because you got some macro relief, inflation came down, the Fed was going to start cutting or stop hiking, or we got a soft labor market, and it just didn't sustain itself because the earnings picture never changed for small caps. You just had this gargantuan gap between mega cap earnings which were rising and small caps, which were flat or falling. We have seen that changed in the last 2.5 months. This is the broadest improvement in earnings we've seen since 2021. And I think it can be sustainable finally. But again, I want to make sure this is not a binary conversation. It's not like all boom or bust. There's shades of gray in the middle. It'd be convenient if everything was that black and white, but we certainly see a backdrop where we're going to see more competition. And I think that has a lot to do with actually softer employment.
Okay. So it sounds like what I hear you say is you expect the market to become less bifurcated, meaning the bottom part, which had really been getting left behind, you think is starting to heal and get a bit stronger. So when you say Goldilocks, then a Goldilocks backdrop for the markets, then maybe you're not necessarily saying, hey, I expect the S&P to leap forward from here, continuing to be propelled by the high growth, the mega growth companies. Presumably we could go sideways for a while, but this bottom half could do very well. So is it more of a rotation that you see where capital is actually coming out of richly valued mega caps and going more into the other parts of the market, or no? Do you see growth in everything going forward?
Yeah, I think again, I like the term broadening. Rotation, I think we have to be careful with because I still think the secular tech story is quite strong. Yes, there are very big expectations built in some stocks, very high elevated valuations. And one day that may end. I just don't think that day is today. So I think it's really from the bottom part of, if we look at this as a K-shaped economy, I think we're beginning to see some healing in specifically some of the more leading aspects of that can represent that bottom part of the economy. So even in housing, do I expect home prices to move higher? No, not really. In fact, they'll probably fall. But do I expect permits and refis and sales data and applications to start improving or continue improving, I would argue, in some cases? Yeah. I think in summary, I can really simplify it. I think employment's going to remain soft and it's going to allow rates to come down. And that's going to allow housing to start healing in some of the leading indicators of housing. And similarly for manufacturing activity, I don't think it's going to be a V-shaped boom, but I think it's going to be a healing. I look at the housing and manufacturing data, it's really been an L-shaped story for the last few years. We haven't seen this broad-based sustained decline in housing activity. It's really hit a bottom in some cases. Like we look at total home sales, like it's hard for them to really go much below 4.5 million annualized. So I think we're starting to see we're coming out of that a bit. So again, a slow and steady broadening, not a V shape, but I think we finally have those conditions where that can be sustainable, recognized, and would give investors a reason to say, okay, I'm not going to just buy small caps because I think the Fed's going to cut, but now I'm actually starting to see some improvement in earnings expectations in some of these companies that have been drastically lagging for many years.
Okay, that's very useful. So in terms of the bottom part of the market and the economy doing better, let's talk about the market for a moment. When you say bottom, are you talking about the small caps? Are you talking about the Russell? Or are you talking like about the S&P 493?
I think all of it, but there's a couple, I think, important nuances that I think are really worth acknowledging. So typically, your best backdrop for small caps is after a big market downturn where they get crushed. So we saw that in March and April. And so you get a rebound in equity, investors jump into risk. Those are only sustained if you have follow through from earnings. So they tend to be driven initially by multiple expansion and macro relief, and then they can continue if the earnings picture is persisting. So you tend to see that coming out of a recession where everything broadly goes down. So that's not been the backdrop. But we, of course, have had this big rebound since the pause in tariffs in early April. So when I think about small caps, we don't have the best environment for them, which is what I just explained, but we do have a better environment for them. And I think if we look back at the last 5 months and say, okay, predominantly what drove the whole market higher was PEs re-expanding or kind of risks and uncertainty coming back down. And you could see this in data. Looking at credit spreads are near all-time lows, which is corroborating why Ps are back to very high levels, whether you look at small caps or large caps. So that kind of part of the story is, I think, a bit played out already. In the last 2 months, why I think small caps have really taken over is because they saw the benefit of macro relief, which everything benefited from that rising tide. And we've seen an improvement in earnings expectations there for a lot of reasons. So when I think about going forward and say, okay, if there's two catalysts, stocks going up, it's PE expansion and better earnings. It is that simple. I think the burden is going to be on the earnings story. And we've used a lot of the fuel up in the macro or PE expansion part of the story. So I don't think it's a blindly go buy small caps because we're all worried about something or the market's worried about something and that worry is going to go away. That's what's happened over the last 5 months. From here, you got to deliver on earnings. So I don't think we're going to see a strong enough economy coming out of this. Or even when I'm talking about breadth, I don't think housing is going to do a V shape or PMIs are going to be in the high 60s anytime soon. So given that, I think it's more of a slow and steady healing, which is, I think, again, a big deal. I don't think it's going to be a boom. And so I think you're going to have to be still selective. But yeah, I think there's going to be more of a diversified return set from the market going forward, and smaller companies will benefit. Cyclical sectors, I think, will continue to benefit. And I think large cap tech is going to do fine. But I think where the biggest rates of change are happening are going to be outside of mega cap tech.
Got it. Okay. Don't let me put these words in your mouth if they're incorrect, but it sounds like an active investment strategy is probably going to, in your opinion, have a higher likelihood of doing better going forward than the passive, just buy the indices and ride them. Because to your point here, it may not be a generalized boom here, but you'll see pockets of the market outperform as those parts of the economy start to heal more.
Yeah. I mean, we've been really in a growth driven stock market. Really, you can go back to 2007 was the peak of value leadership going back 100 years. And value led markets are much better for active managers because they tend to be broader. And growth led markets, if we think back to Mag 7 the last few years, even 10 years prior to today, you think of FANG, and even going back to the kind of GFC mark, it's generally been a very large growth driven market, which is for active managers, it's hard to beat because they tend to be narrow and they tend to reward disproportionately those stocks that are at the top of the K shape. So I think we're cyclically, that K is some, I don't know, closing or wherever the opposite of bifurcation is. I think we're reconverging a bit.
Okay.
But I don't think the outperformance of large growth is going to be matched in the next couple of years by the outperformance of small value equally. So I don't think it's a full rotation.
Yeah. Okay. But it sounds, hey, if you've gotten used to these tasty gains in the stock market, you're probably more likely to get them by finding these pockets of the market that are going to be going through this healing process than just riding the general market indices.
Yeah, absolutely. And I don't want to say it because everyone says it and it's so cliche, but this is an environment, of course, if this plays out, where being more active is, especially in today's benchmark, has a far better shot of beating it. I hope you've enjoyed this excerpt from my discussion with Adam Taggart at Thoughtful Money. Again, if you'd want to see the full video and listen to the entire 1 hour discussion, you can go to Adam's YouTube website at youtube.com/@Adam.Taggart/videos. Have a great week and we'll see you next time.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.